Stop scrolling. Because what happened to silver today is not a normal rally. It is a geopolitical alarm bell wearing a price tag. It is Monday, January 19th, 2026. Wall Street is closed for Martin Luther King Jr. Day, but the world did not pause. In thin holiday liquidity, silver just punched through history. March COMEX silver futures ripped to an intraday record around $94.36 an ounce, and spot silver printed a record near $94.08 before easing back into the low 93s. Gold moved too, climbing to fresh records around $4,689 an ounce, with gold futures flirting with $4,698. This is not a good day for metals. This is the market pricing a new world in real time. And the name of that shock is Greenland. Let me say the quiet part out loud. Silver did not go to the moon because somebody wrote a viral tweet. It moved because the United States just turned tariffs into a weapon inside its own security club, and the target is not an enemy. The target is NATO partners. That is a trust event. That is a currency event. And when trust gets punched, money runs to what it can hold. Over the weekend of January 17th and January 18th, the Greenland story stopped being a weird headline and became a fuse. President Donald Trump escalated his bid to acquire Greenland into a full-scale trade threat. The U.S. announced a 10% tariff on goods from 8 European allies, set to start February 1st. Denmark, Norway, Sweden, France, Germany, the United Kingdom, the Netherlands, Finland. And then came the second line, the one that turns a tariff into a countdown. Those tariffs would jump to 25% on June 1st unless a deal is reached for what Trump called the complete and total purchase of Greenland. Read that again in your head slowly. Tariffs on allies. Inside NATO. Unless the U.S. is allowed to buy a self-governing territory tied to Denmark. If you are a market, you do not wait for diplomats to finish their sentences. You move. Europe moved too. EU diplomats began discussing a retaliatory package reported around 93 billion euros, roughly $108 billion, targeting U.S. goods if Washington goes through with it. In Britain, Prime Minister Keir Starmer called the move completely wrong and warned that a trade war is in no one's interest, even as he tried to keep the relationship from spiraling. Germany and France went even harder, saying Europe will not be blackmailed and pointing to the EU's anti-coercion tools as an option. And this is where Greenland stops being a meme and starts being a map. Because while traders were watching price, governments were moving pieces. European allies began sending planning staff and small military teams to Greenland to coordinate Arctic defense cooperation with Denmark. Call it a show of unity, call it a tripwire, call it political theater, but markets read it the same way. Escalation risk is no longer abstract. When uniforms start arriving and statements get sharper, the chance of miscalculation goes up and the cost of insurance goes up with it. And notice what Europe is signaling with its policy toolbox. A normal response to tariffs is, we will tariff you back. But Europe's anti-coercion instrument is not just about tariffs. It is about access. It can involve restricting market access, limiting participation in public tenders, and using the size of the EU market as leverage. That is why finance ministers are using words like blackmail. They are telling Washington, if you treat us like targets, we will treat you like a coercer. That shift matters because markets are forward-looking. The moment you price the possibility of tools beyond tariffs, you are pricing a bigger disruption to trade flows, to contracts, to cross-border procurement, and to corporate planning. And corporate planning is the quiet engine that moves physical demand. So yes, Greenland is ice, but Greenland right now is also a symbol. The alliance is arguing over a strategic asset with money and security welded together. That is why the market is reacting like this is bigger than a commodity story. Now, I want you to feel the timing, because timing is everything in markets. This crisis did not explode in the middle of a normal trading week. It detonated into a holiday session when the U.S. stock market is closed, when many desks are running lighter, when liquidity is thinner, and when price can gap faster than your brain can update. A vacuum amplifies motion. And when the biggest pool of liquidity comes back online the next day, you do not get peace. You get recalibration. And remember, the metals market does not care that your calendar says holiday. Futures still trade. London still trades. Asia still trades. Algorithms still react. Hedgers still hedge. And the global macro crowd still wakes up, looks at the headlines, and hits the button. So you end up with this strange, dangerous setup. Giant news, thinner liquidity, and the kind of emotional participation that makes a market jump. You could feel it across the globe. European stock markets flinched, especially anything tied to cross-border trade. The dollar lost its swagger, and the classic shelters like the yen and the Swiss franc started catching bids. That is what a trust shock looks like in real time. Not a dramatic collapse, just a quiet shift of weight. A little less confidence in paper, A little more appetite for hard assets, a little more demand for insurance. And the holiday makes that psychology sharper. When U.S. cash markets are closed, people anchor to the few markets that are still open: futures, FX, and metals. That is why metals often look like the first responders. They are liquid enough to trade, symbolic enough to communicate fear, and simple enough to express a thesis quickly. If politics is unstable, own what cannot be printed. That is also why you should not be surprised if the tape looks jumpy. Holiday sessions have a habit of exaggerating whatever story shows up. Then the next full session becomes the reality check. It is like hearing thunder in an empty room and then waiting for the building to fill back up. So yes, there is a volatility bomb sitting on Tuesday, January 20th, when Wall Street opens and has to decide whether this move was a headline spike or the opening act of a new regime. Now let us answer the question that matters. Why silver? Why did silver outperform gold? Because silver sits at the intersection of fear and function. Gold is fear. Gold is a pure trust hedge. Silver is fear plus industrial necessity. Silver is not only a vault metal, it is a factory metal. It is an electronics metal. It is a solar metal. It is a grid metal. It is in EVs. It is in high-efficiency connections, contacts, and conductive pastes. It is the quiet conductor in the machines that run modern life. So when the world starts pricing trade disruption, silver gets hit from both sides. Investors buy it as a monetary hedge, and companies buy it as an operational hedge. That is the double whammy. The same shock that makes people run to hard assets also makes manufacturers quietly stockpile what they cannot afford to be without. And this shock is landing on a market that was already tight, already emotional, already fast. Silver has been moving like a market under stress for weeks. Big daily ranges, sharp runs, sharp pullbacks. You do not get that behavior in a sleepy market. You get that behavior when positioning is crowded, when liquidity is thin, and when the crowd is starting to believe the story. Then you add a geopolitical earthquake and basically the whole structure lights up. Now let us go back to Greenland, because some people still say, come on, how does an Arctic island send silver to the moon? Because Greenland is not just ice and polar bears. Greenland is a strategic runway in the Arctic. It is a security asset. It sits in a region where Russia and China have ambitions, where missile defense narratives get invoked, and where the word control has a different weight than it does in normal politics. And Greenland is also a resource vault, rich in rare earth elements and critical minerals, the stuff modern industry cannot easily replace. In 2026, rare earths and critical minerals are not a side story. They are the base layer. They are high-capacity batteries. They are the magnets and materials that make advanced systems possible. And when a geopolitical power signals it wants to lock down a vault like that, everyone who builds the future gets nervous. Nervous companies do not write essays. They place orders. They pull forward shipments. They pay up. They hoard. Think of it like this. In a normal world, supply chains run on just in time. You buy what you need, when you need it, because global trade feels predictable enough. In a fractured world, supply chains switch to just in case. You buy what you can, while you still can, because you do not know what tariffs, restrictions, or political surprises will hit next month. That switch from just in time to just in case is how you get a commodity rally that feels like a stampede. And tariffs accelerate that stampede. A tariff is not only a tax, it is a clock. It tells every importer and every manufacturer you have a window. If you believe the window might close, you front run it. You ship early, you buy early, you build inventory, you load the warehouse. Because paying 10% or 25% later is worse than paying a premium now, especially if the alternative is a production line stopping. That behavior is what turns a macro headline into a physical squeeze. Now add the European retaliation threat to the psychology. If the EU is preparing a response measured in the neighborhood of $108 billion, that is not symbolic. That is a real list of targeted goods. That is a serious signal that trade friction is becoming policy, not just rhetoric. And the moment trade friction becomes policy, companies do the same thing across the planet. They hedge input costs. They secure supply. They reorder their inventory schedules. So silver gets another bid, not only from investors, but from procurement departments. Quiet, boring people with spreadsheets who do not care about your chart pattern, but care very much about whether they can still get what they need 6 months from now. And there is one more ingredient that makes silver rip harder than gold in moments like this: price. Silver is cheaper. Silver is the accessible hard asset. When fear enters the room, there is a wave of money that wants protection, but cannot or will not pay $4,000+ for an ounce of gold. That wave finds silver. And when a big wave hits a smaller pool, the water level rises fast. That is why the gold-silver ratio can crash in these moments. When silver outperforms, it tells you the move is not only cautious hedging, it is broader participation, bigger emotion, and sometimes a more speculative pulse mixed into the fear. Now let us anchor the numbers, because numbers keep us honest. On January 19th, spot silver surged to around $93.50 and touched a record near $94.08. March COMEX, silver futures hit an intraday record around $94.36. Spot gold rose to around $4,666 and touched a record around $4,689. Gold futures hit about $4,698, and the global mood shifted fast, because those are not small moves. In a mature market, that kind of jump is a signal flare. But here is the part that should make you sit up. We did this with the US markets closed. That means price discovery happened without the full weight of Wall Street liquidity. It happened while the biggest pool of participants was partially offline. That is why the move can look exaggerated, and that is why the next session can be violent. When US traders come back online, they either validate the move with new buying, or they fade it with profit-taking. And sometimes they do both in the same day. So you need to understand something about silver rallies. They are not clean, they are not polite. Silver is a market with two personalities. In calm periods, it trades like an industrial input. In crisis periods, it trades like money. When those two personalities show up at the same time, the candles get wild. Now let me walk you through the plumbing in a way that makes sense. You have spot price, which is the immediate price of metal in the market. Then you have futures, which are contracts. Those contracts are where big money expresses views quickly. When fear spikes, futures can race ahead because contracts move instantly. But then the physical world has to catch up. And when the physical world tries to catch up all at once, you see premiums, delays, and that dreaded word, allocation. Allocation is when suppliers start deciding who gets metal and who waits. And the moment the word allocation enters a supply chain, the psychology shifts from price to availability. And availability stories are where silver becomes dangerous. Because silver is one of those markets where a small mismatch can create a big panic. If the futures market says there is plenty of metal, but the physical pipeline says lead times are stretching, the brain does not average the two. It reacts to the bottleneck. A factory does not need all the silver on Earth. It needs the silver on the day the line is scheduled to run. And if that day is threatened, the price you see on a screen stops being the only price that matters. This is also where you get the strange behavior people misunderstand. Spot price can dip while premiums stay high. Futures can print a new high while a dealer still says, sorry, 2 weeks, maybe 4. That is not a contradiction. That is the market admitting that price and availability are two different conversations. And the higher silver goes, the more that conversation spreads. Some buyers step back because it is expensive. Others step in because they cannot substitute. Investors see the chart and want protection. Industry sees the order book and wants certainty. Those two motives collide, and the collision is what makes silver feel like a rocket. Now add one more accelerant, leverage. A lot of the action in a fast move like this is not patient money. It is leveraged money. Futures allow leverage. Options allow leverage. Leverage makes candles taller, both up and down. When price squeezes higher, shorts are forced to cover, weak longs are forced to add margin, and the market can overshoot levels that looked impossible a month ago. Then, when the pressure releases, it can snap back just as violently. So if you are watching silver and thinking this looks unreal, you are not wrong. Leverage is how real markets create unreal-looking charts. Now comes the part that matters for what happens next. The calendar. The tariffs, as described, begin February 1st at 10%. Then the June 1st jump to 25% becomes the threat hanging over the next 4 months. Whether those tariffs are actually implemented or negotiated away, the uncertainty exists.